Imagine you walk into a bank. You are broke. You are drowning in debt. But the banker smiles and offers you a deal of a lifetime. He hands you a credit card with a $10 million limit. And the best part, the interest rate is 0%. For 2 years you live like a king. You buy the mansion. You buy the cars. You throw lavish parties for your friends. You feel rich. You look rich. The world treats you like a genius. But there was a clause in the contract you didn't read. A tiny line of text on the bottom of page 100. It said, "This rate is temporary. On January 1st, 2026, the rate resets. And you must pay the entire principal back or refinance it at the market rate." You wake up on January 1st. The party is over. The banker is standing at the door. And the interest rate is no longer 0. It is 7%. You do the math on a napkin. You realize that just the interest payment on your debt is now higher than your entire salary. You are not just broke. You are mathematically insolvent. This is not a hypothetical story about a reckless gambler. This is the exact, literal financial position of the United States government. For the last 15 years, and specifically during the madness of 2020 and 2021, the United States put its economy on a credit card. We printed trillions of dollars to pay for lockdowns, stimulus checks, and wars. We added more debt in a few years than we did in the first 2 centuries of our history. But we got away with it because interest rates were at 0. The cost of carrying that debt was free. That era is dead. We are now staring at a phenomenon that Wall Street insiders call the maturity wall. It is a massive, vertical spike in the payment schedule that hits the U.S. Treasury between 2025 and 2026. Approximately $9 trillion of U.S. government debt is coming due. It has to be paid back. But the government doesn't have the money. So, they must roll it over. They must take out a new loan to pay off the old loan. The old loan was at 0%. The new loan is at 5%. This difference doesn't sound like much to the layman. But when you apply it to $35 trillion of debt, it triggers a chain reaction that destroys the mathematics of the American empire. We are watching a slow-motion car crash where the car is the US dollar, and the wall is simple arithmetic. To understand the scale of the crisis, we have to understand the mistake. The fatal error made by the United States Treasury. In 2020, during the pandemic, interest rates collapsed to rock bottom. It was the perfect time for the government to lock in those low rates for the long term. Any homeowner knows this logic. If mortgage rates drop to 2%, you refinance for 30 years. You lock it in. You protect yourself. The United States did not do that. Instead of issuing 30-year bonds or 50-year bonds to lock in the cheap money, the Treasury issued short-term debt, bills and notes that mature in 2 years, 3 years, or 5 years. Why did they do this? Because short-term rates were slightly cheaper than long-term rates. Politicians are short-sighted. They wanted to save pennies today, ignoring the steamroller coming for them tomorrow. They gambled that inflation was transitory. They gambled that rates would stay at 0 forever. They lost the bet. Now, that short-term paper is expiring. Every single day, billions of dollars of those cheap loans are maturing. The bondholders, China, Japan, pension funds, are coming to the Treasury and saying, "Give me my money back." The Treasury has to print new bonds to pay them. But the new bonds carry a coupon of 4.5% or 5%. This is called repricing. And it is happening at a speed that has never occurred in financial history. In 2021, the U.S. government paid roughly $350 billion in interest on its debt. It was a manageable number. It was less than we spent on the military. It was less than we spent on Medicare. Today, just 3 years later, the annualized interest payment has crossed $1 trillion. Let that number sink in. $1 trillion a year, just for the privilege of owing the money. That money buys no jet fighters. It builds no bridges. It educates no children. It is money thrown into a furnace to keep the lights on in the casino. For the first time in history, the United States spends more on interest payments than it does on its entire national defense. We are spending more to pay the bondholders than we are to defend the nation. And this is just the beginning. This is the interest bill before the maturity wall fully hits. Here is the nightmare scenario that keeps Federal Reserve Chairman Jerome Powell awake at night. As we move into 2026, the bulk of that $900 trillion wall hits. This repricing event will push the interest expense from $100 trillion toward $1.6 trillion or even $2,000 trillion very quickly. Now, let's look at the income of the United States. The U.S. government collects about $4.5 to $5 trillion a year in tax revenue. That is your income tax, corporate tax, and payroll tax. That is the credit limit. But look at the expenses that are mandatory. Mandatory means they are written into law. Congress cannot cut them without passing a new law, which is political suicide. Social Security, $1.4 trillion. Medicare and health, $1.5 trillion. Defense, $850 billion. Do the math. Before you spend a single dime on the FBI, the border, education, roads, or NASA, you have already spent nearly all your income. Now add a $200 trillion interest bill on top of that. The math implies that 50% of all personal income tax collected by the IRS will go straight to paying interest on the debt. When a corporation reaches a point where it must borrow money just to pay the interest on the money it already borrowed, it is classified as a zombie company. It is technically insolvent. It is walking dead. The United States government is now a zombie economy. It has to borrow to pay the interest. But borrowing more increases the debt, which increases the interest, which requires more borrowing. It is a doom loop, a spiral, and the laws of thermodynamics apply to finance just as they do to physics. You cannot create energy out of nothing. Eventually, the friction burns the machine down. But wait, it gets worse. For the last 40 years, the United States has been a superpower. We had the exorbitant privilege. We could print as much debt as we wanted, because the rest of the world bought it. China took its trade surplus and bought U.S. Treasuries. Japan bought U.S. Treasuries. Saudi Arabia bought Treasuries. The world treated American debt as gold. It was the pristine asset. But look at the data from the Treasury International Capital, TIDE reports. The trend has reversed. The world is not buying anymore. They are selling. China has dumped hundreds of billions of dollars in U.S. debt. They are selling treasuries and buying gold. Japan is selling treasuries to prop up its own collapsing yen. Saudi Arabia effectively ended the petrodollar agreement. So, here is the supply and demand problem of the century. In 2026, the U.S. Treasury needs to sell $9 trillion of bonds to roll over the debt, PLS another $2 trillion to cover the new deficit. They need to sell $11 trillion of paper. Who is going to buy it? If China isn't buying, if the banks are full, if the Fed is ostensibly trying to shrink its balance sheet, who buys the debt? When you have a massive supply of bonds and no demand, the price of the bond falls. And when the price of a bond falls, the interest rate, the yield skyrockets. This creates the risk of a failed auction. Imagine the Treasury holds an auction to sell $6 billion in 10-year notes, and nobody shows up. Or they show up, but they demand a 7% interest rate to take the risk. If the 10-year Treasury rate hits 7% or 8%, the entire global economy collapses. Mortgages go to 12%. The stock market, which is valued based on interest rates, crashes by 50%. The banking system, which holds trillions in treasuries, becomes insolvent overnight, just like Silicon Valley Bank, but on a national scale. The government cannot allow rates to rise that high. They physically cannot afford it. So, they are trapped. When a sovereign nation faces this maturity wall, when the debt is too high and the interest is unpayable, there are only two doors they can walk through. There is no third door. Door number one, hard default. This is what happened to Russia in 1998 or Argentina multiple times. The government simply walks out to the podium and says, "We are broke. We are not paying." They tell the bondholders, "Sorry. You get 50 cents on the dollar." If the U.S. did this, it would be honest. It would instantly wipe out the debt. But the consequences would be nuclear. The global financial system is built on U.S. collateral. A hard default would freeze every bank in the world. Credit cards would stop working. Supply chains would halt. It would be a Great Depression that makes 1929 look like a picnic. No politician will ever choose door number one. It is political suicide. It is the end of the American empire in 24 hours. So, they will choose door number two, soft default. A soft default is a polite word for inflation. It is financial repression. In this scenario, when the Treasury tries to sell its debt, and nobody wants to buy it, the Federal Reserve steps in as the buyer of last resort. The Fed prints digital money out of thin air. They go to the auction, and they buy the debt themselves. They call this yield curve control. It is what Japan has been doing for years. The Fed essentially says, we will not allow interest rates to go above 4%. If the market demands 5%, we will print enough money to buy the bonds and force the rate down. It sounds like a magic trick. It keeps the government funded. It keeps the stock market alive. It keeps the housing market from crashing. But there is a cost. When the Fed prints trillions of dollars to buy the government's debt, that money enters the economy. It chases real goods. It chases oil. It chases food. It chases housing. This triggers the second wave of inflation. And this wave will not be transitory. It will be structural. This is the mechanism of the soft default. They pay back the bondholders, but they pay them back in currency that is worth less. Imagine you lent the government 100 in 2020. That 100 could buy a week of groceries. In 2026, the government pays you back your 100. They honored the contract. There was no default. But that 100 now only buys a gallon of milk. They stole your wealth, but they didn't steal your money. They stole the purchasing power of your money. Economists have a name for this phase of the cycle. It is called fiscal dominance. Normally, the central bank, the Fed, is supposed to be independent. Their job is to fight inflation. If inflation is high, they raise rates. But under fiscal dominance, the government's debt is so massive that the central bank loses its independence. The Fed cannot raise rates to fight inflation because raising rates would bankrupt the U.S. government. So the Fed becomes a slave to the Treasury. They are forced to print money to keep the government solvent, even if it causes massive inflation for the people. This is the Weimar Republic scenario. This is the Zimbabwe scenario. Now, I am not saying the U.S. will become Zimbabwe overnight. We are the reserve currency. We have advantages that they do not. But the direction is the same. The math is the same. We are entering a period of financial repression. This is a strategy used by governments to liquidate their debt at your expense. How does it look? High inflation prices stay high for a decade. Negative real rates, your savings account pays 4%, but inflation is 8%. You lose 4% of your wealth every year. Capital controls. They make it harder to move your money out of the system. Fed now, CBDCs. Higher taxes. They will come for capital gains. They will come for unrealized gains. They will come for the inheritance. The government is a starving beast, and it is cornered by the maturity wall. It will eat whatever is closest to it, and what is closest to it is the wealth of the middle class. The year 2026 is not an arbitrary date. It is a mathematical certainty embedded in the bond market. The debt has been issued. The maturity dates are stamped on the paper. The bill is coming due. The politicians will not warn you. They will tell you the economy is strong. They will tell you the deficit is under control. They will gaslight you until the very moment the currency breaks. They have to. If they told you the truth, you would panic, and the system would collapse today instead of tomorrow. But you have the advantage of sight. You can see the wall approaching. When a government is forced to choose between bankrupting itself or bankrupting its citizens via inflation, it chooses inflation every single time. Every single time. History shows us that in times of fiscal dominance, paper assets, bonds, cash, savings accounts, are the victims. Hard assets, gold, commodities, land, scarce resources, are the lifeboats. The maturity wall is coming. The refinancing will happen. The money will be printed. The only question is, will you be holding the paper liabilities of a bankrupt empire? Or will you be holding the assets that survive the reset? The countdown has started. You have until 2026 to position yourself. Do not waste the time you have left.